Hi everyone, welcome back to the video. Although I have renamed the channel to focus on Palantir, I will still cover other stocks when there are things worth calling out. In this video, I will talk about the huge backlog of AWS that we just knew through the earnings call, thanks to a question asked by an analyst. It was the last question for the call, but yet the most important one. Also, I will touch on the valuation and explain the possibility that you may be buying AWS and getting all other parts of Amazon for free. As usual, please do not treat this as an investment or any form of advice. My sharing may be incorrect or outdated, so always do your own due diligence. So what has happened to the stock price in the past few weeks? Similar to many tech stocks, the picture isn't pretty for Amazon. It has breached past the 200 moving average at $2,500, which is the line in green, and went down all the way to just slightly above the 2000 level before buyers came in to push the price back up. You can actually see that $2,000 is a psychological barrier or support, plus it was a resistance back in 2018, 2019, 2020 period, which means it forms a possible support right now. As of the last trading day, the stock price was at 2,300 plus, sort of in a no man's land between two key levels of 2 and 2.5k. While the market has been turbulent, the financial results definitely contributed to a certain extent in pulling down the stock price. Since this video is about AWS, I'll just sum up the performance of the company briefly. Top line sales grew by 8% year on year, which is really low, and operating income actually came down significantly as the retail businesses face supply chain headwinds, wage inflation, overbuild of warehouses, which is basically a balloon of costs and many issues that may still continue to impact the company in the next quarter as shared on the earnings call. But what attracts me to Amazon is the Amazon Web Service business, AWS. It solves real-world problems by providing compute power and data storage, which means to start a business, you can do away with the hefty cost of hiring your own manager and getting your own servers. Just pay Amazon a subscription fee and you can do away with a large upfront cost, which is the last thing you want to spend on when you start to build a business. Amazon is the first player to go into cloud services, and they did it quietly in the initial years without showing the breakdown in its financials in order not to alert competitors of its profitable business. It's now the market leader with about a third of the cloud sector, with Microsoft and Google trailing behind. Microsoft has gained market share by leveraging on its large base of enterprise customers and transitioning away from on-premises to cloud. Google is fast growing but still forms a small base and as making a loss. Therefore, you can see that AWS is actually dominating a space right now. From a financial perspective, this is how we can look at AWS business. There are actually two key factors to note. That will be scalability and profitability. Basically, if your product is profitable, then sell as many as you can. The scalability is demonstrated by a strong double digits growth here of near to 40% year on year. In terms of margin, it's trended up from 28% all the way up to 35% in the last quarter. One of the reasons for the uptick in margin is due to the increase in useful lives for the server. As they improve the software to be less taxing on the hardware, it can actually last longer. This means lower depreciation, which is an operating expense, and therefore a higher operating profit and margin can be booked. So I would say AWS can be compared to the leading SaaS companies out there, as both have recurring revenue, scalability, and profitability. Therefore, I will reference AWS valuation to SaaS companies subsequently later. Let's calculate the price to sales ratio together. If we annualize the revenue of AWS today at 18.4B, we'll get about 74B. So if we look at the market cap of Amazon at the last trading period, that's around 1.17 trillion. If you take 1.17 trillion divided by the annualized revenue, that price to sales ratio will be about 16. So keep that number in mind. But wait, AWS does have a large backlog. These are actually contracts that customers have signed, committed to, but yet to be implemented. So this will actually contribute future revenue. So what is the amount? For that, we have to look towards to the recent earnings call transcript. So management state that the backlog is actually at 88.9 billion with an average term of about 3.8 years. So there are two things that stood out for me here. First, the backlog. of 88.9 is actually larger than an annualized revenue that we just calculated of around about 74 billion. Secondly, the growth is actually 68% year on year. That is much higher than the revenue growth of 37% that we just saw. This is a good leading indicator that more revenue is to come in future, and it's really exciting. So right now, let's go back to calculate the price to sales ratio by adding in the backlog. So we can see that after adding in the backlog, the price to sales ratio actually shrunk from a 16 to 7. So right now we are looking at a single digit price to sales ratio for a business growing above 30% and with operating margin of more than 30% as well. How does this stack up against other SaaS companies? Remember, we have calculated two numbers. Just keep this in mind. Price to sales ratio of 16 excluding backlog and 7 including backlog. So first up, we are looking at ServiceNow with a price to sales ratio of about 15. That is very near the 16 that we just completed excluding backlog. So AWS valuation is not that expensive if you use this comparable approach. Second, we will look at Adobe. That's around price to sales ratio about 13. So excluding backlog, AWS will be slightly higher at 16, but if you add the backlog in, AWS looks cheaper at 7. Lastly, we'll be looking at Microsoft trading at near to 11, which is higher than the 7 price to sales ratio of AWS when we include backlog. So you can try a few more examples here, but what we can see so far is that including backlog, AWS, it may suggest that AWS is trading on the low side of the valuation based on price to sales. In case you're wondering if we should use price to operating profits instead to account for the growth and margin profile, you can actually do that as well. But you shouldn't your conclusion shouldn't differ much as the margin and growth profile of AWS is pretty strong and comparable to the top standards of SaaS companies out there. So now we are going to the conclusion. Foremost, we discussed that AWS is a quality company, meaning there is a scaling business that is growing at 30+%. It has high profitability of margins of more than 30% as well. It has recurring revenue that is currently solving real-world problems out there. So if you agree that it's a quality company, then next question is whether is the price reasonable to pay today. For that, we derive a price to sales ratio of 16 excluding backlog and 7 including backlog. Comparing against the top SaaS firms that we just saw, Amazon trades around those levels in terms of price to sales ratio today. And if you think that's a reasonable price to pay, you may possibly infer that the rest of the company, like its e-commerce, logistics, subscription business in Prime, and its very big and fast-growing ad business are coming to you for free. Of course, some may argue that retail business generates negative value, and the cost structure presents significant risk. That is something you have to ask yourself. What are you buying Amazon for today? And what is the future view that you have of these businesses? That's all I have. Please like the video and subscribe to the channel if you find this useful. Do comment below if you'd like to hear more about Amazon or any specific topics that you want me to address. Thank you.